Hi, good morning. This is Matt Sainholtz from Tobias Financial Advisors. We have a few more attendees logging on, so I'll give it about one more minute and then we will start our presentation. Good morning again. This is Matt Sainholtz. I'm the President and Chief Investment Officer here at Tobias Financial Advisors. We will be reviewing the second quarter market returns during this presentation and also kind of giving some outlook as to what may or may not occur in the next 6 months to a year and even longer term investing. Before we dive into the presentation, just a little housekeeping. Hopefully everyone's logged on just fine. In your webinar toolbox, there is a section to put notes in or ask a question. So if you do have a question, please enter it into that text box, and we should be able to address that. And if for some reason we are not able to address that because of time, we will be sure to follow up with you directly. Also, this is a general information session. Anything that we're speaking about today is meant for general purposes and may or may not pertain to your specific unique circumstances. So if you hear something you want to explore further, or how does this affect your portfolio and your situation and what's going on in your life, please reach out to your advisor here at Tobias Financial Advisors. Who we are Tobias Financial Advisors, founded in 1980 by Ben Tobias. We have our 40-year anniversary this year, which we're really excited about, and we're celebrating as best we can, COVID style. If you have kids, we're not doing any sort of birthday drive-bys this year, but we are going to do our best to celebrate. I have 2 young ones, and I find myself doing birthday drive-bys on a regular basis. But we're managing over $400 million for about 200 family members. We really value education here at Tobias Financial Advisors. Our registered investment advisors are certified financial planners, certified public accountants. Myself is a CFA as well as a CFP. A CFA is a chartered financial analyst, and very established and group of tenured professionals that look to give value to our clients on a day-to-day basis. Just a reminder of our kind of overall strategy and approach to investing. And wow, has this last 6 months given our approach a test, but also I think it's also shown that it is a proper and intriguing investment philosophy about sticking to the plan and knowing and focusing on what you can control. You can often create an investment policy on your needs. Your needs are going to be different from your neighbors. It's going to be different than the benchmark, which you might be looking at, say, the S&P 500 or any sort of kind of barometer of the markets. We're tailoring our portfolios to meet your goals and help you achieve your retirement dreams or college funding dreams for your kids. So we structure a portfolio around dimensions of returns. At the highest level, we have stocks, or also known as equity, and bonds, or fixed incomes. Those are 2 simultaneous terms, interchangeable terms that we use. And that's really the highest level of your first decision making. How much stock exposure am I going to have? How much bond exposure am I going to have? And once you kind of understand what the risk and volatility comes along with each of those decisions at the very highest level, then you go down into how we're going to diversify yourself within the stock market world and within the bond world. And we do that broadly. We're doing that across the globe. In the stock and bond world, we're doing small caps, large caps, U.S.-based companies, internationally based companies, different types of bonds, whether that's government bonds or high high quality corporate bonds or even some low quality corporate bonds for an extra juice on the return. You can control expenses and turnover, and looking at the tax picture as well. These are some of the things that we can control, because as we've seen in the last 6 months, markets are a little bit unpredictable, and how to capture those returns is really your long-term investment plan. I was recently quoted in the Wall Street Journal and giving some tips on questions to ask yourself as you are thinking about the portfolio and how to structure your own portfolio. And I was happy to be included in that article. Today's agenda, we will be tackling, kind of like I said, a review of what's happened in the second quarter from the different types of asset class returns and what that means broadly speaking, and then tackle some client questions. What are we hearing? What is most on people's minds? And that'll range from what the economic outlook looks like to what the Federal Reserve and central banks around the world are doing, and different opportunities to invest, and how we're structuring portfolios, and then some overriding conclusion about our 2020 outlook and insights as to where we are in the market cycle and where we are in the world. So let's take a look at the world stock performance. This is the All Country World Index over the last 12 months. And this encompasses mostly larger companies worldwide. But wow, can you see what we lived through with that pretty much straight down drop in the late March to almost being fully recovered on a global basis. This is numbers as of June 30th. And I'll get into a little bit more as to what's caused the run up. Really, it has been several factors, and I'll dive into that a little bit more deeper as we go into the presentation. But just visually, you can kind of see that we've almost had a V type recovery already in these first 5 months or so of the COVID crisis, and that even with the headlines, you have to stay invested. So getting to the numbers, the second quarter market in the U.S. Was up 22%. It was one of the top 20 best performing quarters dating back to the 20s. It's been the best quarter as far as returns since the late 1980s. So we had a tremendous comeback. We had a tremendous rally, and that was fueled by small caps were as well as large caps, but small caps did outpace in the U.S. market. Even internationally, it was up 15%, emerging markets up 18%, real estate up 11%. And then bonds also came back in the quarter as well, with a slight rise of interest rates and some closing of the credit spreads and some of the different types of corporate bonds and credit bonds that we look at. So overall, it was a tremendous quarter. And really what comes down to is that we had support of the federal government and banks around the world to help kind of put us into they gave us a lot of stimulus programs in order to kind of keep us afloat while we first trying to understand how dangerous and what kind of COVID questions and what this COVID crisis was going to do to us economically, personally. And on that note, if anyone's listening out there who's been deeply affected by the COVID crisis, we just want to make sure that we're sending our heartfelt wishes to you for speedy recovery, and that your families are doing the best they can to stay healthy. Here at Tobias Financial Advisors, we're still taking precautions to make sure our team is healthy and doing the best we can to keep our office spaces and our team members safe. And so I just wanted to make a note of that we can talk markets and investments a lot, but there of course is make our best wishes for everyone out there. So globally, I mentioned earlier, we do pick stock funds from around the globe, and just want to give you some updated numbers as of July 13th of what different countries are doing, what different types of where the world has been. So On this 2020 year-to-date column, the local is in local currencies, but we're U.S. investors, we're U.S. dollar investors, so really the currency effects do play into this for international exposures. If I would ask you if you could name one country that is actually up over 15% during this time period, year to date, I don't know if anyone would have guessed China, but China is up over 16% year to date. As without getting political, they were one of the first countries to have the COVID crisis, and depending on the data that you believe in and look at, they're also one of the first countries to come out of the COVID crisis. So, they are maintaining some of their growth. The U.S. Are almost quite back to zero or flat for the year, which is, again, remarkable. We have, if you take out the U.S. and you're just looking at Europe and emerging markets, you're at negative 6% year to date, and so on and so forth from the different asset classes. On the top right, it's always kind of interesting to look at where companies are located around the globe. This is just on that World Country Index that about 57% of publicly traded companies, large companies are traded here, are headquartered here in the United States. And then you have, 43% of the rest of the world, but that doesn't mean they're only doing business in that part of the world. Plenty of drug companies and car makers. I'm sure you've seen a BMW once or twice here living in South Florida. These are global companies as well, especially on the large companies. Really on the bottom right is an interesting chart, and really one of the drivers of why the U.S. has been leading the charge back here in the last few months is that if you look at the gray bar, which is cyclical sectors, cyclicals are finance, banks, energy, materials, industrials. Cyclicals are kind of when the economies are doing well. Cyclicals are doing well because we need cars, we need manufacturing, we need energy to get us to make these factories work. So those are what we call cyclical types of sectors versus technology. As you can imagine, the big technology here in America, we're a leader. Our S&P 500 is heavily weighted towards technology, which has done well in this period of time where people are staying home. We have more of a digitalization in our services, and companies are looking to embrace technology more frequently. So technology has been a big driver in the U.S., which has led the U.S. to kind of lead the world in returns. Now, when we think about what's going to happen going forward over the next 2, 5, 10 years, really when we come out of the COVID crisis, we like to believe that the cyclical sectors will come back as well. Look at, as I said, some of the energy companies. Look at oil. Oil may come back. There's different things specifically about oil that affect that market in particular. But, when materials are needed to keep the factories going, when energy is needed for more transportation around the globe, you should see some of these cyclical sectors come back. The cyclicals are more tied to economic growth, and with looking at cyclical sectors across the globe, you could tell that those types of companies are established more around the world. So I would look for, and we believe that a diversified approach is necessary, and that when we start to get into a COVID recovery, when people are really getting back to work, we should see these cyclicals take off and kind of keep up or catch up to the United States returns, which is heavily led towards technology. Now, what clients are asking, we will dive into our first question here. What is the economic outlook for the remainder of the year and beyond? Just a quick update here on, these are as of June 30th, numbers from JP Morgan. On the left-hand side is daily increases in cases. As we all know, if you can see the gray line in North America, we had flattened the curve. Everything was looking good, maybe not great, but the curve was going in the right direction until about mid-June, and then we've basically been straight up. Daily increase in cases has just skyrocketed almost exponentially, and So whereas contrast that to Europe and North Asia, and even Southeast Asia is going up as well, but like Europe has really contained, and I'll let the doctors and the scientists tell us of why and why not that has happened, but that's the data in front of us, where North America and versus Europe in particular, Europe has seen its caseload dramatically decrease, while the U.S. has seen an increase in cases and fatalities as well. Unfortunately, we're seeing a little uptick as well, whereas Europe is down, comparing it to Europe, and Latin America is just kind of increasing in both cases and fatalities. But what does that mean? Well, this is a forecast from FHN Financial, which is an economic group, some economists that we like to follow, and this is kind of a consensus out of a lot of economists that we do look at, is the fact that we saw a significant drop. The world shut down. This is the U.S. data that you're looking at here, but pretty much worldwide, economic was basically a shutdown. And as predicted by the New York Fed weekly economic indicators, it was pretty much straight down, and economic activity stopped. And so most economists are predicting that we'll start growing again here, even in the third quarter and fourth quarter in the U.S. And then in 2021, and maybe in the early 2022, we'll see economic growth pretty much get back to where we were pre-COVID. That's the general consensus of the economists that we watch. And it's interesting. The New York Fed they didn't really have a lot of weekly economic data released, but then they've actually, because of the crisis, because they needed more quicker, faster information, they are actually publishing now this weekly economic indicator, so that gives us more of a pulse on the U.S. economy and what's happening. And so this is what the economists are suggesting, that we're going to have growth is going to come back at some point in time. There'll be some vaccines. You can debate when and how fast it'll get out into the world, but overall this crisis will be behind us. There will be some changes and maybe some sectors and different parts of the economy. Of course, there's going to be some winners, some losers, but the world should come back online here in 2021, and that's what the market's showing us. So if you take a look here at the market, as you may recall, is a discounting mechanism. It is trying to look into the future, and based upon earnings, corporate earnings, maybe 9 to 12 months out, that's what the market's discounting. So that's why you see this big dichotomy between the economic data, where you see headlines where, oh my gosh, unemployment over 10%. These are the worst economic numbers we've seen since the Great Depression, or very long time. And yes, that is true. Yes, it's scary. Yes, we feel for all of those folks that are struggling right now, whether that be through their health or through work. But the jobless claims have been coming down. That's the yellow bar. You can see them spiking up in April. Jobless claims have been coming down, pretty consistently throughout the past couple of months, and the S&P 500 has increased. So, what the market's telling us is what a lot of the economists are telling us, is that when 2021 happens, we should be kind of back to pre-crisis era as far as economic corporate earnings. There's a thought process that basically the 2020 earnings have been, they're just, companies are getting a break from several analysts out there, and that's what's happening. That if you can, 2020 is going to be very tough. Everyone understands that, but 2021 is what the market's pricing in, and that's why we're seeing such big returns and had such a great quarter, because we knew a lot more about COVID, and the jobless numbers were coming down. And there's going to be some threats to what I just said, but that's kind of the consensus that we're looking at, is in 2021, the corporate earnings will be back to normal. We'll tackle that more when I get to the outlook session of our 2020 rest of the year outlook. So what do the Federal Reserve's recent actions tell us? So this is a chart from 2018 to 2020 about market expectations and what central banks around the world have done. You can see the red number, the Fed, this is the United States. Our central bank, pretty much immediately during the crisis, dropped their interest rate policy to 0, 1.5 to 0, and more in line with the rest of the world, where previously Bank of Japan and Europe have been in 0, even negative interest rates in their forecast and what they're allowing their banks to loan at and what they've set their interest rate structure. So our central bank has been very, very supportive and accommodative to borrowers across the country, which has led again to the increase in the S&P 500 and kind of, back in March, I've told folks before when we're doing our portfolio review meetings that basically March was just fear, panic selling. Nobody knew what was going to happen next, and it was just scary for the world. The economy shut down. No one knew how bad this crisis was going to be, how bad it was going to get. Thankfully, we've had some positive news on COVID. Not perfect, don't get me wrong, but this support has helped the stock market and just kind of everyone take a big sigh of relief that the central banks around the world are doing the most and the best that they can with their policies and making it accommodative. So, I think we have some tailwind behind that. That hasn't felt its effect all the way throughout the economy. Typically, when there's an interest rate cut or interest rate increase from the Fed, that does take 6 to 9 months to kind of filter through the economy, people to refinance their mortgage. So that's another indicator, another reason why we think growth will return for the rest of 2020 into 2021. But what does it do for bond funds and interest rates? Again, here's the 10-year U.S. Treasury bond interest rate changes for the last 8 years, and you can see from 2018 to now, a 10-year bond is, this is as of March 9th, it's not much different. Yesterday I saw that 0.6%, but a very low bond, 10-year interest rates. And so, what does that mean? There's negative interest rates in Europe. The Federal Reserve has kind of come out, and no one's really advocating for negative interest rates here in the United States. That's a whole nother topic of conversation we could dive into. I won't go too far into it right now, but I think that's an appropriate approach from the Fed, and that negative interest rates really don't spur lending as much as they may think it does, and really kind of doesn't really do justice as to. It's hard to get out of them as well. It's hard to get out of the lower rates, but with rates this low, relative to stocks, you're kind of having to investors of all different types, pension funds, individuals, corporations, global wealth funds. You're being pushed out into more riskier assets because of the low interest rate. So on the right here, you kind of have different types of bonds. High yield bonds are bonds that are issued by companies that are typically rated BB or lower, and these pay more, but there's a reason for that, because there may not be an opportunity for that fund to or that company to pay those back. So going left to right, you have kind of higher bank loans that are variable rate, and you have multi-sector bonds and non-traditional bonds where you let a bond manager go in and get all different types of bonds, whether that be mortgage backs, credit backs, credit supported obligations, all different types of bonds, and so on and so forth. And what this chart here is basically saying, as interest rates, in a normal interest rate environment, when interest rate falls, the value of your bonds go up. So on the far right over here, when falling interest rates are happening, you'd want to be in long-term government bonds or core government bonds, and you should be rewarded for having these longer dated bonds. On the flip side, when there's a rising interest rate environment, which we don't think that's got to be the case for a couple of years. I think you're going to be able to still get a low mortgage rate for a year or two until we're really through this this crisis. So you should be looking at, if you have a mortgage right now, you should be looking to see if that refinancing makes sense, student loans, any sort of liability. You'd want to think about perhaps refinancing and making sure that you're getting the best deal out there. And your advisor here at Tobias Financial Advisors can help walk you through that. But in rising interest rate environments, you can say longer dated bonds are not as supportive, not as beneficial to rising interest rates. So where are we trying to position? We're more positioned in the short-term bonds and these non-traditional multi-sector bond funds. We give our fund managers some leeway to go find us opportunities in maybe the high yield space. Some of these companies are going bankrupt or look like they're going bankrupt. You might be able to get a good deal on a good bond and get a nice return there. So we let some of our fund companies that we use, JP Morgan or TCW, MetWest, kind of go out there and look for these non-traditional bond funds. And these are, when interest rates go up, these are the places to be. Where do we see opportunities to invest? This is just a kind of a reminder of what we lived through. How much money is just sitting in money market funds as of this is as of May 2020. But you can kind of see, interestingly, in January 2003, kind of towards the after 9/11, towards the end of the tech bubble, you had kind of a peak in the dollars that are just that were in money market funds. At the bottom of January 2009, if you might recall, the March 2009 was the bottom of the stock market of the global financial crisis. You can see this spike in money market funds there. And we're kind of, we're at a spike. Now, whether that spike's going to last 2 years or not, that's not something that we have insight on right now. But typically when these spikes do happen and there's a rush to money market funds, the 3-year U.S. stock performance on an annual basis is very positive. So you can see on the right, after the peak in 2003, on average, we had returns of 16% a year. In the great financial crisis, we had average returns of 19% after the peak in money markets. So there's a lot of money on the sidelines, as I said, and with interest rates being low, that leads to me to think there's going to be some sort of I won't say floor, but some sort of protection on the downside from the stocks, and the fact that there may be a floor because all this money is on the sidelines, making zero. So when there is pullbacks in the stock market, there may be opportunities. There may be investors out there that will come in and buy and keep the market at least on an upward path or a stable path going forward. So, I'm showing this to say, stay invested. Of course, no past performance does not guarantee any future results. I think we all know that as investors. But this was a very interesting chart that I came across, and I wanted to share it. Again, on the money markets, just real quick, some of the money markets out there are these massive money markets are paying 0.101%. There's such a low interest rates out there. Asia, as you saw, Asia ex Japan, China was one of the best performing countries so far year to date. And this is share of global GDP. The yellow line representing Asia ex Japan has been steadily growing since the early 90s. And the growth there has been, obviously, their share has increased. Someone has to have a decrease in share, and that share is coming from North America, Europe, and Japan. Some of the more established economies of the world have seen their growth slow, and comparing that to Asia, vice versa, Asia has been up. So, when we develop our portfolios, we do develop them from a global perspective, and this kind of reiterates that as well. This is GDP growth historically for many years, and the purple line is the emerging markets, and the gray line is developed markets such as Japan and Europe, those types of economies. They're still growing, still consistent expectations for GDP growth over the next 12 months, still positive in the emerging markets. Emerging markets, when we say emerging markets, it's China, these countries over here to the right, China, Brazil, Mexico, India, there is a kind of a demographic, economic phenomena that is being predicted, and that we've seen some degree of it already, and that's kind of the growth of the middle class. A lot of these countries have really low labor costs, and as time has gone on, they've seen a kind of a middle class emerge in these types of countries. These middle classes, when people get to that stature, obviously they're more consumers and less factory workers. So, services and consumers will be, those types of industries may be beneficial in the future in emerging markets. And then forecast it out, you're looking for a little percent of total population, you're just going to see this huge uprising of middle class. And those are customers that not only American companies can take advantage of, but customers that'll be on a global scale. Now there is something called the U.S. election coming up that many would say, thinking about China and the United States together, that the rise of decentralized or deglobalization and more economies that are more in-house, so to speak, those that may happen, but it still doesn't mean that these types of people coming out of the middle class are still going to have to be serviced by someone. So that's why we believe in a broadly diversified approach, and that emerging markets are a really good allocation in most of our portfolios. So this chart is one of our favorites to show, but it's a lot to look at. It's pretty a lot going on here, a lot of data. I'll do a brief job to give you some high-level thoughts on it, but basically, across left to right is years 2005 to 2019, and then up and down within those years are an asset class and a return for that year, and each asset class is represented by a specific color. Let's pick on orange. Orange is U.S. small cap, U.S. small companies in the United States. In 2013, they were a leader at 38% of returns for that year, whereas in year to date now they're at negative 13%, and has been a kind of a laggard on our portfolios and a diversified portfolio. They're bringing down returns. So, our way to invest is a globally asset allocated portfolio, which is the white boxes or the black line that goes through here, which is kind of a diversified, kind of a 60% equity, 40% bonds and other type of portfolio. Year to date, given this is JP Morgan's weighting, they allow us to take some of their data and information here, and we have year to date as of June 30th, kind of their version of a balanced portfolio is down about negative 4.5%. But the real story here is that we like to remind folks of is to stay diversified. We have just picking on orange again, sometimes it's above the line, sometimes it's below the line. It's really difficult to predict these things on a annual or even monthly basis. So that's why we do stay invested. And over the last 15 years, what's been at the top of this chart over the last 15 years? Green. That is U.S. large companies. That has been a leader for the last 15 years. And I'm not saying that we're giving up on the U.S. or anything like that, but we are advocating for a diversified approach across the globe, where just as things are leaders, the U.S. has been a leader. There's times where someone leads the race, and sometimes when others will step up and lead the race. And we do think that international is marked by emerging markets, and then Europe. Europe just, if you've been following the news, Europe just came to an economic conclusion, and basically they approved the first ever European federal debt to combat their COVID crisis. So all the different countries in Europe actually came together to the table to issue debt from all of them. And that is monumental, and really something that may lead to more European positive outlook, because now they have a coordinated approach to give stimulus to their economy, and therefore that would be beneficial. So this is our 2020 outlook and insights. I think the overall list here, you see 4 points for optimism, 4 points for caution. I mean, I think we are cautiously optimistic that we are going to continue to see either some stability here in the U.S. markets and not return to some sort of crisis period like we were back in March. Why we say that? We had a solid economic foundation coming into the crisis. We weren't in a recession at that time. And so, once we get out of it, we feel that we should be able to get our U.S. economy moving. I've talked about a coordinated policy response. I just talked about what Europe was doing with their federal loan program. The U.S. Federal Reserve drops rates to zero. And we have all sorts of lending facilities out there. All this is going to be headwinds to keep the economy getting past this crisis, which was a tremendous slowdown. I've talked about the attractive value between stocks versus bonds with the U.S. 10-year at 0.5%. I mean, you're talking about giving your money to the U.S. government, and then 10 years later they give you interest of 0.5%. So that makes stocks look still attractive from a relative standpoint. And just we have more room for optimism on COVID in general. We have vaccines that have been now in the works for 4 or 5 months. We're throwing plenty of money at that. Companies and governments across the globe are putting money into the finding a vaccine or at least some sort of better treatment plans. We're learning more about contact tracing, and really we just know more about it. And the U.S., of course, there could be a double dip. I mean, we're in Florida here. We are definitely experiencing if you want to call it an extended first wave or a second wave. We are definitely feeling it here in Florida. But that is unique to us, and we do know more about the crisis. So, why we are not, all in, there's reason for caution. The second wave, as I just mentioned, U.S.-China political tensions. We have the U.S. elections coming up. Depending on what happens there could be some drag on the U.S. taxes, or maybe I would say drag, so U.S. tax increase to pay for all this support. So we might see higher taxes in the future, which we're a financial planning firm, so that means we need to think about maybe taking more money out of your IRA, maybe possibly converting that to a Roth account. And really, thinking about your tax perspective and long-term tax rates. And valuations aren't necessarily cheap as they were at the bottom in March. And so we, people with cash on the sidelines, we typically advocate for kind of a stage entry back into the markets, or a dollar cost averaging approach, where you buy a little bit at a time and then kind of develop your position in that regard. So that pretty much concludes our outlook and insights. If you are not a client of Tobias Financial Advisors and would like to have your portfolio reviewed on a complimentary basis, you could go ahead and put your name and phone number into the text box, and we'd be happy to get back to you this week to give you more information about how you can address that and do a portfolio check-in. And of course, if you are working with us, please give us a call. We're happy to go more in depth into how the portfolio is positioned and our reasoning for our outlook, and what we are doing in the portfolios and your financial plan to help you achieve your goals. I'm not seeing many questions in the box today in our approach, so we do thank you. And once again, thank you for your trust that you put on us as your financial planning team, and we look forward to speaking with you in the near future. Stay safe, take care, and be well.